Hey everyone, I'm going to try not to yell, and I realize that a lot of that stuff is coming through loud. I wanted to talk about treasuries a little bit. We haven't done that yet. I haven't. Again, SIE level treasuries. So, treasuries are bonds issued by the US government. So, the government needs money. So, they need money to spend it on wasteful things. I'm just kidding. There's different ways they can get the money through taxes straight up. But when they need money, what they'll do is they'll issue T-bills, T-notes, T-bonds, tips, and strips. Those are the ones. Those are the ones that they issue. T-bills, T-notes, T-bonds, tips, and strips. So the short-term ones are T-bills. T-bills are basically 1, 3, or 6 months, maybe a year. They haven't done that in a while, but they can. So 1, 3, or 6 months. That's how long T-bills are. Now, do we know about bonds that they pay every 6 months? So if you have a 3-month T-bill, how does it pay every 6 months? So what they do is that instead of getting coupon every 6 months or so or over a period, they get it at the end. So this is zero coupon. So a T-bill is issued at a discount like $9.95. You pay $995 for it. And then in 1, 3, or 6 months, we get $5. So we get $1,000 at the end. So we paid $995. We get $1,000 at the end. That's $5. That's your interest, and it's taxed on the federal level, not state and local. Okay, and it's called a discount security. It's actually quoted at a discount. So if you think about it, when you buy a T-bill and you buy it for $995, you're getting $1,000. You're making $5. $5 out of $1,000 is 0.5%. So you bought it at 0.5%. If you bought it at $990, you make $10, which is 1%. That's how they're quoted by percentage or the discount yield. Okay, so now the next one is a T-note. T-notes and T-bonds are basically the same thing. T-notes, T-bonds. T-notes are 2 to 10 years. They pay coupon every 6 months. So if you buy a 4% T-note, you're getting $40 a year, $20 every 6 months. It's 2 to 10 years. They are a coupon. You buy them at par, which is $1,000. They settle at par or they mature at par, and you get $1,000. So you give the government $1,000. Why would you? I don't know. But you give the government $1,000. In 2 to 10 years, they give you back your $1,000, but you get $50 or $40 every year. Okay. They're quoted as a percentage of par. Like if par is 1,000, you buy them at 101. That's actually 1,001. That's a 101%, which is $1,010. But the quote is not in eighths or fractions. It's in 30 seconds. So really, if you see 101.4 or 101-4, it's actually 101 and 4/30 seconds. So that means 4/30 seconds, 4 divided by 32 is an eighth, 0.125. So if you bought it at 101 and 4/30 seconds, you really bought it at 101.125, which is really $1,011.25. Rewatch this if you're not getting it. T-notes and T-bonds are the same thing that way. So we buy it at par. It ends up, they mature at par. We get a coupon every 6 months. T-notes are 2 to 10 years. Now a T-bond is basically a T-note, but it's up to 30 years. So again, buy a par, matures at par. You get a coupon every 6 months, but it's good for 30 years. So you're going to give them $1,000, and 30 years later, if you're still alive, you get your $1,000 back, but you've been getting interest every day, every 6 months. Now, T-bills are zero coupon, no accrued interest because there's nothing to accrue. T-notes and T-bonds have accrued interest because if you buy it in between the premium, in between the payment periods, you're owed some of that interest, so the buyer has to pay you. Again, Series 7 is deeper. You can talk to me about that. Now, a strip. I have a joke about that, but I'll leave it out. So a strip is a long-term zero coupon. You buy it. So FINRA loves it for college education. I disagree because of the inflation risk, but it's there. So a strip is a long-term zero coupon. You buy it at like $600. And in 10, 15, 30 years, you get back $1,000. So that $400, if I use the numbers right, is your interest, but you're not getting it to maturity. You pay nothing. You get nothing during the life of it. But the bad part is the IRS goes, hey, we don't want to wait till it pay you, so that we're going to make you adjust your cost basis. Again, Series 7 thing, we're going to make you adjust your cost basis and accrete the bond. And you have to pay taxes on that little bit of interest that you haven't gotten yet, but the IRS says you did. So it's kind of crazy. So what happens is accretion, you're paying tax on money you haven't gotten yet. That's called phantom income, okay? Phantom income is basically doing it that way, getting money, remember, I'm doing it without a script, so my ADD mind goes nuts sometimes. So you buy it at 600, you get 1,000. Say that's over 10 years. That's $400 that the IRS says you're going to get in 10 years. They don't want to wait. So you're going to take that 400, divide it by 10, which is the 10 years, and they're going to say, oh, your bond went up in value by $40, which is 400 divided by 10. We're going to tax you on that. Even though you didn't touch the money, they're taxing on you. That's phantom income. You're paying taxes on money you didn't get. Only the government can do that, okay? Now, that's a strip. Long-term, zero coupon, super volatile, because if you remember from my other videos, long-term, low coupon moves the most. You can't get lower than zero, so that's a lower coupon. Now, a tip is a regular bond. You buy it at 1,000, matures at 1,000. It pays you every 6 months, but what happens is the par value is adjusted for inflation, which is the CPI. So par value is 1,000, and say you have a 5% bond, $50 every year. But say inflation goes up by 10%. It would never do that here, well, hopefully not. But if it does, then what happens is the par value of the bond will go up to by 10%. So now it's 1,100, and it's 5% of 1,100, which is $55. So again, you were getting 5 before. Inflation went up by 10%. You're now getting 55, which is 10% more. It keeps pace with inflation. It doesn't beat it. It hedges against it. It does not beat it. What's the best inflation fighting tool? Common stock. Common stock is the best tool for long-term inflation fighting. TIPS is a strong second because it matches inflation. You're not going to do better. It's not going to beat inflation. It's going to match it. So again, bills, notes, bonds, tips, and strips. Bills, short-term, zero coupons. Notes and bonds, basically the same thing. Notes are 2 to 10. Bonds are up to 30 years. Tips, strips are long-term zero coupons. It's a zero coupon that you buy at a discount and it matures at 1,000. That difference is your interest, and you're taxed every year. It's very volatile because it's a zero coupon. And then a tip is a Treasury inflation protected security. It adjusts the par value so that your payment adjusts with inflation. Now, taxable. The interest on Treasuries is taxable on the federal level, not the state. Unlike munis, which are taxable on the state level, not the federal. So think about it. The entities tax themselves. Yes, munis, if you buy it in your own state, you don't have to pay taxes. But in general, Treasuries pay federal taxes, not state. Munis pay state taxes, not federal. Now, I think we're good on that. I think there was one other thing. Oh, a Treasury receipt is very much like a strip, but it's issued by a broker-dealer. As far as an investor goes, it's the same freaking thing. But as far as we go, a Treasury receipt is a long-term zero coupon. But what the broker-dealer does is they'll buy, or the bank, they'll buy the bond and split it. They'll buy a regular T-bond, split it, and then they will sell it to you as a discount. So if you buy a strip or a receipt, as far as you're concerned, it's pretty much the same thing. The only difference is who you're buying it from. So now, Treasuries, no default risk across the board. T-bills have no risk. They're the risk-free rate of return. T-notes and T-bonds have no default risk, but they have interest rate risk, reinvestment risk, and not really call risk. Those are the risks, and inflation risk. Strips have no reinvestment risk. There's nothing to reinvest. They have no default risk. They have interest rate risk, a shitload of it. They have, and that's kind of it. And they have inflation risk. Tips have reinvestment risk because you're getting a coupon. They have no default risk. They have no inflation risk, but they have reinvestment risk and some interest rate risk, even though interest rates and inflations kind of go together. So now, I didn't do it in the beginning, but please subscribe and hit the little bell so you know it's coming. I am doing another live tomorrow night at 8:30. Please join in. Tell people. The busier it is, the better. The busier it is, the longer I stay on. Usually after about 25 minutes, the questions go away. And anyone who's taken the test and passed it, please come on. If you can give some tips on what you saw, I'd love to see it. Again, the live is both for SIE and Series 7. These things hopefully mostly SIE, but I'm trying to do that. I'm also figured out a way to do a live screen and share my screen while I take a test. So I'm definitely doing the Notman pretty soon. I'll give them props for it. but I'm going to take their free thing and try to give you some answers. Again, tomorrow night, 8:30 Eastern time, I'm doing a live. Please join. And good night, y'all.